housing is a source of strength within the U.S. economy. It had a bad year last year, given the higher mortgage rates and the SALT cap and the impact that had in certain areas. But I think the fundamentals of housing are good. Prices are higher, but they're not excessive relative to rents and to income. And if you look at the supply-demand fundamentals, the housing vacancy rate is low, and the labor market continues to be strong. So if you look at the supply-demand drivers, I think housing continues to be a source of strength for the U.S. economy.
Alan, the numbers we got in May were great numbers. June, some of the numbers we've gotten so far have not been wonderful. I know we do get some more numbers on new home sales later this morning. How much are you kind of waiting on these numbers?
After what we saw in the fourth quarter, when housing was very weak, as Ed says, we're looking at both orders as well as some of the new home numbers going forward. The double headwind of the higher home prices, which made housing less affordable, and the higher interest rates really took a number on the home builders. But if you look at Lennar, they've improved from orders down 4% in the first quarter to orders actually up in the quarter they just reported this morning. If you look at the Evercore ISI home builder survey, that's shown sharp improvement over the last couple of months. So we're looking at whether or not the extent to which home builders are improving throughout this year is going to have a better impact on the broader economy.
How much of this is housing and how much of this is what happens in the global economy and what happens in these trade talks?
So much of housing is tied to interest rates. And with so many sovereign bond yields negative, it's very difficult for U.S. interest rates to remain where they were last year. And so consumer housing demand is affected by a lot of things, but with the real wage growth that we're seeing, that certainly helps. And with low interest rates, there's no question that that helps as well.
I'm sorry, I mean more in terms of what the market's looking at right now. What's the most important factor?
For the broader markets?
Yeah.
Well, I mean, there are a lot of cross currents in the broader markets right now. So, I mean, I'd say, on the negative side, there's the escalating trade war, rising geopolitical risks in general. Global economic growth is probably the weakest that we've seen since the financial crisis, and U.S. economy is still relatively strong but slowing. But on the other side, we've got global central banks now getting their liquidity fire hose ready and in place. So that's reducing some of the tail risks.
Let's just talk about the catalyst this week.
Okay.
G20 meeting.
Yes.
President Xi, President Trump sit down, they talk. Nothing is cemented in terms of a deal, but it looks like they are at least talking once again. What does that mean for the markets? Are stocks underpriced here, overpriced, or fairly valued?
Well, I think a good scenario for risky assets would be that we at least get some sort of détente, right? Some sort of trade truce ahead of the presidential election year. And then if we have that in the context of still decent valuations and dovish central banks. You have to remember that 16 central banks cut rates during the second quarter. That could be a good scenario for risky assets.
Could be a good scenario, meaning you would expect to see stock prices go up if that's the case?
Yes. Yeah, I think so.
Ellen, you agree with that?
Well, I think housing is important, to your point earlier, Becky, because the consumer is about 2/3 of the U.S. economy. And as we've seen, business fixed investment has been soft. So the corporate third has been relatively soft. You saw Jay Powell mention that in his prepared remarks last time. And so you really need the consumer to be strong. And housing is a big part of consumer. And so if we can see animal spirits improve because of more confidence about trade, more confidence about détente globally, then that will help the economy to keep going.
You expect to see the consumer be much stronger in the second half of the year than in the first half?
If real wages keep improving, then that should happen. So we've seen real wage growth for the first time in the last few in the last few years, and we are seeing wage growth now in the 3.5% range, so that should help.